Good morning. This is the first of the series of free short online lectures on how to build financial forecasts. The presentation will be divided into three parts. In the first one, we will make an introduction to financial forecast. Then we will move on describing how to how to build the pro forma income statement and the pro forma balance sheet. Let's start with the introduction. A financial forecast is made of two main tables. The first one is the pro forma income statement and the second one is the pro forma balance sheet. In the pro forma income statement, we have two sections. In one section, we have all the revenues of our company, and in the other one, we have all the costs of our company. The difference between costs, revenues, and costs gives us the profit of our new venture or the loss if costs are higher than revenues. This means that the pro forma income statement enable us to answer to questions such as what are the expected sales? So this is the starting point. How high will be our revenues? How high will be our expected sales? What are the costs of the goods sold? If we want to sell a given amount of products, we will have to manufacture and sell them, and so we will have costs. How high will be those costs? What is the expected profitability of the project? The difference between revenues and costs. And when is the company expected to break even? Through the financial forecast, we can establish on the basis of our assumption when we will be able to cover all the costs with other revenue. That is when we will be able to break even. That's the meaning of break even. So this is the first statement. The second statement in a financial forecast is given by the pro forma balance sheet. In the pro forma balance sheet, again, we have two sections. In one section, we have the assets, that is the uses of funds. How are we going to use our funds? We can use our funds buying fixed assets, that is equipment, furniture, computers, and so on. But we will use our funds also in other ways. For example, we will have accounts receivable, that is the money that we have to receive from our customer if we sell our products and we are not paid at once. Those are accounts receivable. Another use of fund is represented by inventory, that is the goods that we have already bought, that we have already manufactured, but are still in our warehouse, have not been sold yet. So those two items, accounts receivable and inventory, together are part of the so-called working capital. On one side we have the uses of funds. On the other side of our pro forma balance sheet, we have sources of funds. Where do we get the money from? Those sources can be represented again by items of the working capital. For example, accounts payable. We buy goods, we do not pay our suppliers at once, and so we have accounts payable, money that we own to our suppliers. And this helps us in financing our assets. Okay, so again, this is part of the so-called net working capital. This item, the accounts payable, belong to the set of the items within the working capital. Other sources of funds are represented by the liabilities, for example, bank overdraft or mortgages, or again other kind of liabilities. A final source of fund is represented by equity, that is by the money given to the company by the partners, by the owners of the company. So the pro forma balance sheet helps us in depicting the uses of funds on one side and sources of funds on the other side. And that means that this table enables us to answer questions such as what will be the future need for fixed assets? How much money do we need to finance fixed assets? What is the level of the working capital? Inventory, accounts payable, accounts receivable? Which sources of capital are available to cover the company financial needs? Bank overdraft, mortgages, equity, and what is the need for external financing? How much money do I have to ask to external investors or banks? So those are the two tables which together constitute our financial forecasts. In order to build those two tables, it's very, very important to classify the items that we will have to place in the two tables in the way that you see represented in this slide. Cost and revenues, which are in the income statement, assets and liabilities in the balance sheet, can all those items can all be classified in this way. First of all, we have to distinguish between operating and non-operating items. Operating items are linked to operating activities. That is the main revenue creating activities of the company. For example, if we manufacture bicycles, operating activities are represented by the purchase of raw materials, the manufacturing of bicycles, and the sales of our bicycles. Those are operating activities. We have cost, revenues, assets, and also liabilities connected to our operating activities. Revenues for the sales of the bikes, costs for the purchase of raw materials or for the payment of our employees, assets for the equipment that we have to buy in order to manufacture our bicycles, and also liabilities, because when we buy raw materials, maybe we do not pay at once, and so we'll have accounts payable for our suppliers. So this group of items are linked to operating activities. Another important group of items is represented by non-operating items linked to non-operating activities. Here we have two main groups of non-operating activities. The first group is linked to the financials of our company. Here we may have two basically different situations. First situation, we have, this is the most common one, we have from operating activities a total of assets for, let's say, 1,000, and the total operating liabilities for, let's say, 200. The difference is 800. So we need to finance our company for the total amount of 800. So we have a financial need. So we have some items in our balance sheet linked to financial needs. This financial need can be covered with equity or financial debt. So we have these are two liabilities linked to the financial need. We have items linked to financial need in the balance sheet, that is bank overdraft, mortgages, equity. But we also have items linked to financial need in the income statement. If we have a bank overdraft, on the bank overdraft we pay interest. So interest expenses are in the income statement and they are linked to financial need. In other situation, we may have sources of funds from operating sources of funds which are higher than uses of funds. For example, when we have a lot of accounts payable, when we have a very high equity linked to high profitability, and so we have more money than we need, the amount we need for our uses of funds. In this case, we have a financial surplus. Again, this is a non-operating activity. If we have a financial surplus, we may invest it in low-risk investments, and from those investments we may get an interest. So in this case, we would have items both again in the income statement and in the balance sheet. In the balance sheet we will have the low risk investment, the amount of low risk investment, and in the income statement we will have revenues linked to these investments. Another group of items is related to taxation. Again, we may have these items both in the income statement and in the balance sheet. In the income statement we will have taxes, and in the balance sheet we may have liabilities for taxes to be paid. Just to give a complete picture, only in the income statement we may also have the so-called irregular items. For example, non-recurring costs, exceptional costs we may have in a given year. I will not spend time in covering those items, as in a financial course, in a financial forecast, those items are very rare. So I don't think it's useful to lose time for those. Okay. We have presented the main picture, and now what we are going to do is to deepen the first group of items, operating items, because those are the most important ones when we develop, when we build a financial forecast. So items, operating items can be divided into two main groups. Some items are linked to volumes. For example, revenues are linked to volumes. The more bikes I sell, the more revenues I will have. Raw materials are linked to volumes. The more bikes I have to manufacture, the more I will have to buy raw materials. These items are therefore very, very flexible. They increase when we increase our revenues, and decrease when we decrease our revenues. We have some items linked to volumes even in the balance sheet. For example, accounts receivable. The more I sell, the higher the revenues, the higher will be our accounts receivable if I'm not paid at once. Let's move to the other group, fixed items. Here again we have two subgroups. A first important group is represented by structural costs linked to capacity. For example, in the balance sheet we have equipment, investment in fixed assets in general, equipment, furniture, vehicles, and so on. In the income statement, examples of fixed items are given by costs that do not vary in relation to revenues. For example, the rent or the cost of employees. Most employees are paid regardless on how much we sell. So most of the cost of the employees is fixed. Or legal costs. So this is a first group. A second group of fixed items is represented by costs and other items linked to development. Mainly they are costs, but we may also have other kind of items. For example, costs for R&D, for research and development, or advertising costs. This kind of costs is not linked to volume, but it's not even linked to capacity. I may have a startup, a new company, that spends a huge amount of money in R&D. So this kind of costs have to be kept separated from the other, as they are linked to the future. We can also call this group of costs development costs, because they are linked to the future, not to our present capacity and production. Okay, let's give a picture which helps us in understanding the difference between fixed items and variable items. And let's focus in particular on costs. Variable costs are linked to volume. As I sell and manufacture more units, variable costs increase. They do not increase in a linear way, as for very large increases in revenues, I may have, for example, discounts in the purchase of raw materials, and so we do not have a linear relationship, but we have a curve. Fixed costs are not linked to volumes, but they are linked to production capacity. So they are fixed, but when I increase my production capacity, fixed costs do increase. So they typically increase by steps. This is true for fixed costs linked to capacity. Development costs are not linked to units, so I could even depict them on a graph such as this. For the sake of financial forecast, they are usually added to fixed costs, so they are added on the top of fixed costs. So just to summarize and to make it very clear which are the costs included in each category, let's have a look at the list of variable and fixed costs. So variable costs are raw material costs, costs related to packaging, the purchase of packaging materials, subcontracted work costs. If I manufacture some of my components outside my company and I pay on the basis of the number of components manufactured, I have this kind of costs. Then sometimes utilities, for example, for companies with very high energy consumption, the electricity can be a variable cost. Direct labor if variable, but usually labor is fixed, is not variable. If I have temporary workers, for example, they may represent a variable cost. Transportation costs, commission on sales, which are the commission that I pay to agents that help me in selling my goods, and commissions on credit cards. Those are examples of variable costs. Examples of fixed costs are listed in this slide. As we have seen, fixed costs have to be divided into two main groups: structure cost and development cost. Structure costs are linked to capacity. Examples of fixed cost linked to capacity, that is structure cost, are fixed labor, general and administrative expenses, depreciation and amortization. Okay, this has not been explained yet. We will do it later on. Anyway, just to give you an idea, depreciation and amortization is the part of the cost of the fixed assets, which is considered the cost in a given year. For example, if I buy an equipment for 100 euros and I'm going to use it for 5 years, I can decide to divide the cost of this 100 euros among the 5 years when I'm going to use the equipment. So every year I will have a depreciation of 20. 100 divided 5 is 20. Every year I will have a cost for the year of 20. Anyway, we will explain this better later on. Other fixed costs linked to capacity are insurance, equipment maintenance and rental, building rents, utilities, if fixed electricity, for example, licenses, legal and professional services, travel and entertainment. Examples of development costs are on the other side given by advertising, marketing, research and development, consultancy services, training and development. Okay, we can close this first part of this introduction to financial forecast. In the next online lecture, we will see how to build the first part of the income statement, the part related to operating revenues and costs.